this is going to be a treat for you because I'm going to show you some pretty interesting things about risk management. A lot of it's going to be maybe review if you've seen other videos, or maybe if you've never seen anything before, this is really going to be for you. But I think you're going to get something out of this video, and I'm really excited to show you really my take on risk management. So the first question, of course, you got to ask yourself, but a lot of people still know this, but they still ignore it, and never ignore it, is how much are you going to invest trading? And don't put money you can't set aside. If you can only risk $500, you only risk $500. Don't bet the house on trading. Trading is not something that you want to be stressed about that money, because if you're stressed about the money, you're going to make irrational decisions. You don't want to be emotional. The less you start with, probably the more successful you can be. That's a really big thing you need to hone in on yourself and let that really stick with you. Don't put too much in there. Everybody's financial situation is different. Only put and start in with what you can afford. But I'm going to show you how you might not need as much as you think if you really can get clever with this. And trading doesn't have to be that stressful. You should have demo traded for a while before you even start going live. This is for a trader that's using live money. So now there's two different paths you can take. I myself do sometimes the high leverage, high reward with a small account. And I'll get into that. And then there's what most other gurus teach, which is a standard risk and a percentage conservative. And we'll go into that. So let me just get to the high leverage, high reward with a small account, because I'm sure if you've never heard anything like that, your attention's up. And you might have seen other videos and you might say, what? That's too much. That's crazy. So let's hear me out on the whole thing. Hear me out on everything. Because I myself, and I know a lot of other people that have made a lot of money doing this. And I even found other random traders that actually have done this too and have been successful. The first thing you got to have is the right broker. I'll put a link in the description which broker I use. They give you a bonus, and they give you very high leverage. And you don't have to use all 1 to 3,000. This broker goes up to 1 to 3,000. You do 1,000, 2,000, whatever you want. Really, the big thing also is you're able to get a bonus. So you get a 50% bonus with this broker, and you're able to actually use that. So if it's all or nothing, and I'm playing with the house's money, what's not to love about that? So let's run an example, because we just said a lot. So for example, we deposit. Let's say we know that we can risk $200 each time. We have $1,000, and we want to risk $200. That's what we want to do. So in this method, you're not going to get this every time, but it's a numbers game. So you, on average, if you're good at this method and you have a high probability trading strategy, you're really good with the charts, you're really accurate, then you hope to make 2 to 5 times more than your deposit. So $200, you're making $400 to $1,000 on those trades. I've seen 10, 20, 30, even 50x money. Now that's not every time, and it takes a little bit of skill, and you're not going to hit 20 X's on every single time. Sometimes you may only make 2 times your money, 3 times your money. But long run, if you're really just entering just perfectly and don't buy all in at once. You buy when you start to accumulate profit. You buy into the winning trade, and you get a nice long move into it. Now, worst comes to worst, you blow out your account. Okay? What do? You redeposit and re-enter. This is not a method for everyone. But you divide up your money so that it's not that painful. If you have let's say a few $1,000s to play with, this method, you can use $100, even a $50 account. I said $50 account, yes. $50. I've made 10x on a $50 account before. It's possible. And then you have more money to play with. But each time you don't make a few thousand doing this, which is very possible, and then redeposit a few thousand. No, each time you deposit a little bit. The whole point of this method is deposit little to make a lot. That's the whole thing. Now, let's say if you do make it big, like I just said, you make 2 to 5 times the amount, maybe even 20 times. You withdraw the gains, and you trade again. It's that simple. Repeat, 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 repeat. It's going to be painful. Now, obviously, you can make a lot, but the disadvantage is the stress of reloading. So you can do what I call the $50 method, which is the lowest possible method possible. Sure, on a $50 account, you could turn it into $75 pretty easily, $100, $150, $200, $300. It's possible. And then you accumulate a few thousand. You can accumulate, over the course of a little bit, pretty good money. A $50 method, you could really, if you're really, really, really spot on, you could make up to $500 a week on that. If you're just depositing $50, you might lose. For example, if you're using the $50 method, you might lose 4 or 5 times in a row. But you keep trying. That's why you do very little. You keep going, keep going, keep going. This is for traders that really are very, very confident. Very, very, very confident, and they're okay with losses. But the beautiful thing is you know exactly how much you're risking every single time, and you have a good chance of making good money. Are you going to win every time? No. You may only win a third of the time, but the beautiful thing is you only need one really good win to make up for a lot of losses. That's the whole point. So that's that method, and I also can go into more details if you give me a shout out on Instagram as well. I can kind of see if I can work with explaining that a little bit more with you. So the other method is, the standard, super conservative, or you can be a little bit more aggressive type of method, which is pretty much taught by every trader, or guru or whatever you have. So, and a lot of traders, they don't really follow this. The reason why most traders fail is because they have a $1,000 account and they risk 50% each time, and that's all their money. Notice that even with the small account method, high leverage, high reward, we're not betting. If we have a few $1,000s, we're not betting $1,000. We're betting a couple hundred each time. So we have like 50 chances to win, even with this method. You want to spread your money out. You want to spread your money out so that you have as many redeposits as possible. You don't, if you have $3,000 to trade, you don't want to deposit $2,000. That would just be insane. For like the high reward small account method. So for the standard risk, for example, you have a percentage. So it's the big thing about it is you're risking a percentage and you're trying to make a percentage. So you risk no more than, for example, 5%. Some trader 10% is very aggressive. You can grow very quickly with 10%, but you can also you'll lose your whole account in 10 trades. 5% you lose it in 20. 1% you have 100. So maybe you could even do 1%. And if you have a pretty big balance or you get a funded account, then you are able to maximize that long term. So most traders are within that 1 to 3% range, like I mentioned. But the whole point is that with 1 to 3%, if you let's say lose 10 times in a row, you still have plenty of capital left. You still can come back. So you can compound and grow the account long term. So with that being said, so for example, if as the account grows, the percentages change with the dollar value. So for example, if the account grows from, let's say you do really well, and your account grows from $1,000 to $2,000, your 5% risk, for example, grows from $50 to $100 each trade. So if you place a trade at $1,000, 5%, it's 50, and then if your account balance now grows to $2,000, you risk $100 if you're doing 5%. Just giving a rough example. So for risk to reward ratio, which is you got to factor in for this kind of thing, you would need a 51% ratio to be profitable if you're risking 1-to-1. So if you risk, for example, 5% to 5%, right? If you're going to make 5% to risk 5%, which is kind of you got to be pretty good. Is that possible? Is that win ratio possible? But keep in mind, most traders only fall between, are only like 40%, 45%. Most traders are. A good amount of traders are 50 to even some are 60. But you're not going to be right all the time. You got to and to know your winning percentage, you have to look at a lot of trades, like maybe hundreds or even thousands, to really know your true winning percentage. Not just, you demo trade for 3 weeks. That's not going to tell you enough. So that is a very important thing to keep in mind. 2-to-1 is pretty good. Most traders are around 2-to-1 or 3-to-1. That's pretty good. And then, it also comes down to what are you really trading a strategy you believe in? Are you really trading a strategy that's decent? Are you trading a strategy that's back tested, that has proven itself, especially on something like demo? So, and then the other question is, are you doing a very strict order entry system, where are you just placing the take profit, placing the take stop loss, and just just sitting on it, and then walking outside and walking your dog and saying I don't care, or going to the movies, or you just set it and forget it? Some traders do that, and some traders do okay doing that. So it doesn't always hurt to put a take profit, stop loss, or something, especially because life happens. Even for a full-time trader that does this full-time and that's all they do, life happens. You got to go somewhere, emergencies, whatever. Doesn't hurt to you're deep in a trade and you got to be pulled away from the chart. Happens. But a lot of trades, some traders really just want to watch and see how things play out. Maybe they think that there's a news event or some crazy reversal might happen, or they want to see how price reacts, and they're not really sure how it's going to play out. So they want to eyeball it the whole time. So if you're eyeballing it the whole time, your risk to reward ratios aren't always going to, let's say you just get out once the momentum. Well, then you may aim for a good risk to reward ratio, but it might not always play out the same. Maybe you should test out and see really where your risk to reward ratios are playing out. If you're manually closing them like that by not actually setting it and letting it hit the take profit or the stop loss. So that's another thing. So the advantages, it's conservative. It takes a long time to get blown out or lose your balance. I mean, it's a great way for a trader to really learn about themselves, and if you're risking only 1%, which is pretty good for a very, very new trader, you have 100 chances. 100 failed trades in a row to lose. Maybe if you want to risk 1% to make 3%, something like that. That's also possible, right? If you're doing a 1-to-3 risk to reward ratio, that's kind of a standard thing. So then also, and that's just an average. So the disadvantages, it's slower, but if you're really having a good strategy, it's not impossible to really grow and scale your account. So really how you calculate this is for any method, is always take the size of your account in terms of equity. Maybe the broker has a bonus that'd be factored in there. That's why I say equity. And you divide by the lot size, or dollars per pip. So if, for example, you have $1,000 account and you're trading a standard lot, you have 10 pips, and that's it. And then that account will be broke because it's $100 per pip, for example. So, and here's another example. So $1,000 account, 5% risk, and let's say you want to do $50. If you think it's 25 pip is going to be the move, you would use a 0.2 on, let's say, a conservative account. or $2 per pip. So, or this would not be so this would be a little bit, what 5% most traders would not consider super conservative. So 0.2 would be your lot size. The big thing is a lot of traders aren't using the proper lot size, right? The lot size, really you got to factor in what percentage you're going to be risking, what percentage is your reward, and really putting your money into perspective. There's a lot of calculators out there that are useful for making sure that you're able to do this. But trading responsible and really making sure your money lasts long term is the most important thing. So here we have it. We've really learned 2 different methods that have the potential to make you grow. You know, the high leverage, high reward with a small account is definitely not for everybody. Can make a lot of money. You can even start it on a very little bit of money and grow it up. And then the standard risk percentages, textbook, I think really tons of traders on YouTube mention it. Tons of textbooks mention this type of material. That's also something for you as well. And really, either or can make you money. Either or. If you have any questions, I'm always on Instagram. I answer questions. I teach people all the time this types of stuff. Please give me a like, subscribe if you found this information useful. And until then, I will see you then.